Major averages lower here to kick off the trading week, but as we look ahead to 2023, our next guest says that high yield is compelling for long-term investors. Brandywine Global Portfolio Manager John McClain joins us now. John, make the case here for us and what particularly this could set up for some of those long-term investors.
Oh, absolutely. You know, for the first time in forever, we think bonds are interesting again. And in terms of the case, high yields never had back-to-back negative years, and we believe the valuation right now is compelling. So you're starting with a yield at close to 9%. That's pretty healthy. And investors should be focused on this all-in yield because of the move that we've seen in treasuries year to date. We think the duration is actually somewhat attractive in the marketplace. And really, this dollar price that we have now at 87 cents on the dollar allows for price appreciation as well as the coupon that you're getting. And what we talk about is yield to outcome opportunities in fixed income. So you may have a bond trading at 80 cents on the dollar and a company gets acquired. And what we've seen also, too, and we think this is really important, we're in the early innings of a monumental shift in capital allocation policy from corporations. So companies now are focused on living within a certain leverage target. They're focused on using cash flow to reduce debt as opposed to reward shareholders. And so now we've got corporate CFOs working for us as bondholders. And we think that investors should really jump on this.
I mean, John, when you talk about this big shift, right, it would be a big shift back. But in other words, everybody's saying this year 60-40 is dead, right, because the bond market has been such a stinker. So unusually a stinker along with the equity market. And what really stood out to me in your notes to us is you said 60-40 is alive and well. Not only that, it should be 40-60 next year. That feels like a pretty radical statement right now, even with the yields that you're getting on the fixed income side.
Well, I mean, that's one, we think fixed income is attractive, and two, we think equities are not attractive at this point. And it's all about valuation, again, at the end of the day. When you look at equities, I mean, I think we're going to go through this earnings recession. We've seen the earnings start to trend down here. We've seen, the consumer struggling a little bit. But, again, Fed policy leads to lagging effects. So I think what we're seeing now is really the result of the hiking that was going on 3 to 6 months ago. So we're going to continue to keep hiking here. And I don't think that companies are going to be able to continue to pass along the price increases that we've seen in 2022, in 2023, when the consumer is struggling a bit more. So as earnings go down, valuations need to come down. And again, I don't think that the Fed is going to go into a more dovish stance in 2023. So I don't think we're going to see interest rates go down in 2023. So now we've got a competitive good to equities. TINA's not the answer anymore. There is a competitive and compelling alternative to equities. And so we think you should be fading equities here and buying fixed income.
John, how do you think corporate bonds will perform next year if we do get a mild recession?
Yeah, I mean, we're set up, particularly in high yield, in a pretty attractive position here. So even if we get a mild recession, what you need to worry about from a lending perspective is, can companies continue to make their interest cost payments? And absolutely, companies borrowed hand over fist in 2020 and 2021 at particularly low rates. So it's like locking in your mortgage in 2020 at 2 3/4. You don't care that the market's now 7% for a 30-year fixed mortgage. You've got it at 2 3/4. So these corporations have cheap capital right now. They have no maturity wall to speak of. They have access to plenty of tangent pools of capital in the marketplace. And then from the asset class level, we've got commodity exposure in our marketplace. Energy is a big component of high yield. That's a tailwind as opposed to a headwind in prior cycles. You've got structural seniority in the marketplace, meaning that a lot of these lenders are borrowing senior secured. There's assets behind the debt. So we feel like your recoveries in a bankruptcy or restructuring would be higher than they have been in prior cycles. We feel very confident that this marketplace is set up to withstand a reasonable recession, particularly because we went through a default cycle in 2020. So the truly crappy companies in the marketplace are gone. And really, we've also seen the excess lending in the marketplace go to other areas like leverage loans and private credit.
Let's pick up on private credit for just a second here, because that area has really grown enormously over the course of the past couple of years, really taking on a lot of the credit market. What happens now? to that area?
It's I believe in Santa Claus, but it's marked to make believe in private credit right now. You had an asset class that's grown rapidly over a short period of time. It happened in high yield. It happened in leveraged loans. And the hangover effect is years of, challenging returns. And so we've seen this explosion in private credit lending. And, there's not as many good ideas in that marketplace. And what we've seen also is, look, we see what our market returns in the public sphere. And, high yield leveraged loans up 5-6% in 2021. And we're down double digits this year. Private credit was up 20% last year, and it's down low single digits this year. That doesn't make sense in fixed income because you have a contractual coupon, a stated final maturity. So as long as you avoid defaults, if you had a lot of winners in 2021, they're going to become losers in 2022. And we're not seeing that in this marketplace. And we also think that there's a lot of lending in software technology businesses in this space. And, we think that technology is really in for some pain going into 2023.
For what it's worth, John, I still very much believe in Santa and leave him cookies every single year, as I will this year as well. John McClain, portfolio manager at Brandywine Global. Always good to see you. Talk to you soon.